Welcome, dear traders. You're watching a recap of the Asian session. On a Thursday morning, sentiment in the stock markets became bearish. Most Asian stocks slid into the red zone, following the release of a weak earnings reports of big tech companies. For example, Netflix or Tesla disappointed investors with their profit results. The main focus today was on news from China. Actually, market tensions intensified at the start of this week. Retail sales data was published on Monday. After April's high of almost 13%, the June reading plunged to 3.1%. And this report raised concerns about a downturn in the world's second largest economy. At the same time, analysts believe that Beijing could adopt additional stimulus measures to stimulate the domestic market. In their statements, the Chinese authorities are quite optimistic about the country's economy. The People's Bank of China decided to keep the interest rate unchanged. As the Chinese currency has been under strong bearish pressure this year, the regulator has taken measures to support the yuan. It was adjusted rules to allow companies to borrow more from overseas and to make it harder to buy dollars. China's largest state-owned banks were selling dollars to buy yuan. Yesterday, Beijing stressed that the country's foreign trade was not bettered by economic factors. China's ambassador Xi Fang gave a more insightful speech, and he criticized the U.S. restrictions on foreign investment and the export of AI chips. If the U.S. does not revise its stance, China will take retaliatory steps, the official warned. The deterioration of U.S.-China relations, geopolitical tensions, and concerns about the sluggish recovery of the Chinese economy may support the safe haven yen. After testing a weekly high of 140 on Wednesday, it was rather volatile in the Asian trade. The dollar-yen pair hit a bottom in the range of 139.10 and 139.70. After that, it managed to reach 139.62. Although the yen is still trading in the red zone, its upside potential is limited. Japanese stocks also faced a sell-off in the morning. Perhaps demand for Japanese equities was affected by the report on the country's trade balance. For the first time since July 2021, the indicator unexpectedly swung to 43 billion yen. Exports climbed by 1.5% as a stronger yen and falling commodity prices led to lower costs. Imports slipped by 12.9%, the sharpest decline since September 2020. And traders are also waiting for the Bank of Japan's rate decision. The meeting will be held next week on July 28. Kazuo Ueda is widely expected to maintain an ultra-loose stance to keep inflation at a stable level of 2% per annum. Therefore, investors are more focused on the Fed's rate decision as well as Jerome Powell's speech. Investors remain cautiously optimistic, and they believe that the tightening cycle is coming to an end, and the US dollar decreased across the board. Nevertheless, analysts believe that the depreciation of the US dollar this year is likely to be limited. Its sharp drop last week did not last long. The greenback was able to break above 100 points. It was trading above this level in the Asian session, and yet it was still stuck in the price range of 100 and 130. There are signs of a growth, albeit weak ones. In the morning, the Australian dollar snapped its four-day losing streak and resumed growth. Its robust rally was driven by unexpectedly strong domestic market stats. The employment rate in the country more than doubled the forecasts. It surely improved market sentiment. As a result, the Aussie saw the biggest intraday gains for the week. It jumped to 0.6840. For the rest of the Asian session, the Aussie USD pair did not move. It consolidated in the price corridor of 0.6765 and 0.6841. The New Zealand dollar also managed to assert strength. The kiwi approached 0.6290 in Asian trading. As inflation in New Zealand remains at 6%, traders hope that the Reserve Bank of New Zealand will stick to its hawkish stance. In addition, China has promised to improve private business conditions. A rise in the yuan, bolstered by Chinese banks, triggered an increase in its liquid proxies. After weakening in the previous 4 seasons, the kiwi entered the bullish channel of 0.6252 and 0.6309. However, New Zealand's economy is already going through a technical recession. The situation may become worse. Therefore, a rally of the kiwi is likely to be short-lived. And that's all for now. Hit the subscribe button and keep your finger on the pulse with us. See you soon.